Okay, we're going to switch gears right now. Up until this point, we have been talking about our own money and helping our customers manage their own money. But now we're going to talk about other people's money. We're going to talk about money that we can use from individuals or, more importantly, financial institutions. So we're talking about other people's money now. Oops. And to do that, we have a poll everywhere. We're going to go through some credit myths and facts. It seems credit is this mysterious thing that we have. So let's learn more about it. Okay, credit reporting agencies approve or reject a person's request for credit. True or false? Okay, did we get all the answers? Oh, okay. Delay. Okay. All right, so credit reporting agencies approve or reject a person's request for credit. That is false. The request for credit is approved or denied by the financial institution that you are applying for credit with. So the next question, I guess that's me again. Information in a credit report only affects a person's finances. The information in a credit report only affects a person's finances. That's the question, true or false?
You giving me answers? Giving the right answers.
Okay, how are we doing? Okay. So the answer to that question is false. It affects a lot more than just personal finances. We'll talk about it in a minute, but it can affect your job, it can affect your insurance, it can affect renting an apartment.
My credit score will be lower if I view my credit reports. True or false? What do you think? I can't hear all the other offices, but I'm hearing a lot of falses here, although I got a thumbs up from Dave. The actual answer to this one is that is false. If you are only checking your credit report, it does not affect your credit score. If you are just looking at the reports, which we'll get into that in a minute. Viewing your score your credit report has no impact on your score.
And just as a side note to that, make sure that you are the one who is reviewing your report. If you say, well, I've got a friend at a bank and he or she can pull my credit report and I can look at it. No, the bank now is the one pulling your credit report, not you. So make sure it's when you yourself are requesting your own report. So I must keep a balance on my credit card in order to build a credit history. True or false? False. The answer, of course, is false. You do not need to keep a balance. What's really important to do is to make those payments on time. If you charge whatever and then pay it off at when the bill comes due, that's fine. That's a better measure of building your credit history.
All credit repair companies can fix your credit problems. True or false? I'm hearing a lot of falses in this room. The answer is, in fact, false. There should not be companies out there that say they can repair your credit. The only way that you can do that is that most of them are scams. You can fix errors on your credit report, and we'll talk about how you do that in a minute. You don't need to pay anybody to do that for you. You can do it yourself. And again, a lot of these scam companies will say, oh, for a fee, we'll fix everything, get your score better, and they are scams. And again, you can call 1-800-PA-BANKS to find out that they are in fact not licensed in the state of Pennsylvania.
Okay, all credit reports are the same. True or false? The answer is false. The creditors themselves have the opportunity to report to whatever credit reporting agencies they want. They can report to one or all three of the main ones, which we'll talk about in a minute. So you really need to check all three of your reports because they can be different based upon what's reported according to the businesses that you deal with.
All right. If your employer wants to see your credit report, do you have to give them permission? So my employer must have permission to see my credit report. True or false? Not so sure on that one. A lot of questioning tones. The answer is actually true. As an employer, they must get your permission. Now, the fine print is that it might be in the fine print. If they have you signing a job application, it may be somewhere near your thing. We will be pulling your credit report. So if you haven't actually read that, you might miss it. But the employer needs to have permission to pull that report for you.
And it has to be in writing.
In writing.
In writing.
Right. Good.
Well, the safest place to get a loan is at a bank, credit union, or savings bank. The safest place to get a loan is at a bank, credit union, or savings bank. The answer is true.
Except for the bank of mom and dad, but
Yeah, I mean, think about going to a loan shark, if you will. Just saying, that's not a safe place to get a loan. Or pawn shop, again, not a safe place in terms of cost and the rights that you would have with getting a loan.
And actually something we've seen a lot lately at our department in our consumer affairs unit, they're getting calls about auto title loans. People go into these shops, give over the title to their car to borrow, maybe a little bit of money about what, a little bit more than what the car might be even worth. And these people sign over their titles and then somehow can't make the payments back. So that's one other, people are losing their cars. And we've had a couple companies we've shut down that weren't running appropriately, but auto title loans are a very dangerous industry. So again, you want to warn your consumer or customers about things like that as well. Oh, we have another poll everywhere.
Poll everywhere. If I qualify for credit, I must be able to afford it. True or false?
Ooh.
If I qualify for credit, I must be able to afford it.
The results of that are 80, okay, it's still fluctuating a little. 86% of you say false, 14% say true.
The answer is, it's false. One would think, logically, that a financial institution wouldn't lend you more than you can afford. But what you determine as what you can afford and what you feel comfortable with should be the limit of how much you're borrowing, not based on what somebody else or what a financial institution doing general financial calculations can tell you. You are in control of how much you borrow. Make sure that you are comfortable with how much you have to repay.
Yeah, the best example of this is probably mortgages. When people are shopping for homes, you'll walk into a bank, get pre-approved, and you're pre-approved for probably $100,000 more than you can actually afford. When you start including in escrow and other taxes and things, when people are shopping, they're like, oh, I was approved for a $350,000 house. And when you actually back the numbers down, you've got to be very careful. So it's again, institutions are happy to lend you money, and they don't necessarily mind if you get in trouble, although...
well, that's not good either.
Let's not go there either, right?
Right, yeah.
Anyway.
Okay, so let's talk about credit. We've done the polls, and thank you, Sarah, for doing all that for us. So what is credit? Credit is other people's money that you can use. Of course, you're promising to pay it back, and it's not free. There are costs that are associated with it. Credit is very convenient, and we pay for that convenience. The two main types of credit out there are called installment and revolving credit. Installment credit is basically known as a once and done. These are your mortgages, your student loans, your auto loans. You borrow money for a specific purpose, you pay it back in monthly installments, and when you've paid it off, it's done. You don't have access to that money again. Whereas revolving credit, these are our credit cards. You have a certain credit line, you can use it, pay it off, use it again. As long as you keep making those payments and you're under your limit, you can still, continue to use them. You also have flexibility in how much you're paying, how much you're using and paying with revolving credit. Okay, so why is credit important? We mentioned this a little bit before. It's important because it affects more than just our finances. It affects our ability to get a job. Those with compromised credit are less likely to, get a job. It's going to affect the fact that you're not going to work in, with financial responsibility of an organization. I mean, think about it. If you can't manage your own money, why would a company want you to be involved with managing their money? And it's also, statistics have shown that those with compromised credits are more likely to
Steal.
Steal, thank you. Yeah,
Embezzle.
engage in employee theft is what I'm looking at. Rent. You have to have decent credit in order to rent an apartment. I mean, that's the reality. So as we're helping our customers move towards independence and towards, renting their own apartments, it's really important that they establish good credit. And lastly, insurance is another area. Insurance rates are really dependent now upon credit and how you're managing your money. Because again, those with compromised credits are more likely to file a false insurance claim. So it's all in the statistics, but it's really, again, it's not just about our money and how much we're paying for it. It's about all of these other things that can be affected by poor credit or good credit. So how do you establish it? I guess first and foremost, take out a personal loan and pay it back. That's the best way to do that. Get a credit card, make charges, make the payments on time. Again, remember, you don't need to have a balance on that credit card. It's that use that really makes the difference. And then also with your other non-credit bills that you have, your rent, your cell phone, utilities, anything else, make sure you're making those payments on time, because if you don't make them on time, that's going to be reported about you. We'll talk a little bit more about that in a couple of minutes, but really important ways to establish credit.
Can I interrupt for one other second? One other thing, if you've got a client or customer who doesn't have a credit history or a very solid credit background, one other thing they can do is order or get a secured credit card. You walk into a financial institution, bank or credit union, and if you have $500 saved, they'll open up a line of credit for you against that $500. But that way they know they're going to get their money because they have it, and then you're not touching it, but you're making charges over here and hopefully paying it off and on time. So a secured credit card is another really good way to help someone build credit or establish it if they haven't had any to date.
So let's talk about credit cards in a little bit more detail. I think the majority of us probably have one. If I can make a 2 or 3, if I can make a general statement. But they're really convenient. It's a convenience to have a credit card. A lot of times you'll need one to rent a car or make other online transactions, things like that. So they're an important part of our financial being. Of course, it's revolving credit. You have limitations on how much the financial institution will let you borrow at one time. That's called a credit line or credit limit, line of credit. You will get a monthly statement, and as Becky said before, check that statement. Credit cards have the flexibility. You can pay the balance in full, or you can make the minimum amount. It's really your choice, but just know that if you're not paying the balance in full, you're going to get charged interest on a daily basis for the balances in that account. Again, there might be an annual fee associated with that. So you really need to do your diligence and shop around for credit cards. We didn't mention this before, but in the book we have Penny Pincher. She gives us cute little tips on financial information and advice and special reminders, I guess, to help us really focus on things that are important. So with credit cards, remember that, and help our customers remember this as well, is they are responsible for those purchases. The credit card companies, not that they don't care who makes it, but if there's an error that they don't see as odd, as in Becky was saying, that they do catch these things, you are responsible for that. Our customers are responsible, so they need to check their statement on a monthly basis, and we'll look at one in just a minute. Watch the low introductory rates. Okay, you might have low interest for the first 6 months, and after that, it might go up to, 15, 20, 24%, whatever the rate is. So you have to be careful in how you're using it and the timing that you're using it if you're taking advantage of those bonus rates. And remember that if you don't make your payments on time, that's going to adversely affect, thank you, your credit history. So make those payments on time. Some additional facts about credit cards, as we said before, when they're used correctly, can help you build a good credit history. Important to make those payments on time. Can't pound that in enough about making those payments on time. Try to get a card with no annual fee, or if you do have one with a fee, ask them to waive it. They might be able to do that. Maybe ask them, hey, I don't want the card with a fee. Can you just waive this now? Because otherwise I'm going to close it. I mean, that might be something to say. And if you can't pay the entire balance of your credit card for several months, there might be some issues of spending more than you can actually afford. So you have to be careful about that. I'd like to, maybe better to look at page 44 in the book if you have access to it. There's a great sample of a credit card statement, and I just want to point out a few of the sections that we should check over on a monthly basis. You have a summary of account activity, how much you've charged, how much you've paid, what your fees are, etc. You have payment information. It's important to know what your outstanding balance is, what the minimum payment is, and most importantly, when it's due. Then there's information on what happens if you're late making your payments, specifically if there is a fee or if your interest rate is going to be increased. Really, really key of keeping that in mind. Last but not least, they're saying a minimum payment warning, but I think most importantly, look at this information. If you're only making the minimum payment, how much is it going to cost you in the long run? How long is it actually going to take you to pay it off? These can be substantial. If it takes you 2, 3, 4, 5 years to pay off a credit card making the minimum payment, think about what that's going to do to your cost. And the reason why by law now credit card companies have to show this is because we want, regulators want people to understand the consequence of long-term balances on their credit card. It's very, very expensive.
A couple tips on prepaid cards. If you've got a customer who does not have a bank account and maybe they're getting a prepaid card or maybe their employer is paying them on a debit card, and I don't mean debit in the sense that it's linked to your checking account. There are some upsides to having these prepaid cards. They're useful for people who don't have bank accounts, obviously. You can't get into debt using them because they're preloaded with whatever money you have on them. And therefore they can help you budget your expenses. Now, some of the downsides of having a card like that is, one, you don't build any credit by using a prepaid card. There's no one's reporting to anything because it's like a secured card again. Some cards have activation and reloading fees. We had a gentleman in our office. He has a son who plays baseball, and he's like, I'm going to get him a card that he can use and swipe at the games and get himself a hot dog and a soda while he's playing or after the game or whatever. And he went out and he bought a prepaid card, and I guess it doesn't matter which company it was, but he had to pay $10 just to activate it. Then he wanted to put $20 on the card, and then he started reading the fine print on the back, which he brought into me to show me, and it was like $2.50 to check the balance. Every month there was a monthly service charge just to maintain something. So the $20 he put on, he figured was going to be gone, whether his son used it or not. It was going to be gone within about 2 months. And so it's like the fees that come out of some of those prepaid cards do not make them cost effective. You're just throwing money away. So again, we highly encourage people to actually have accounts. Some of these cards have expiration dates, and you have to be very careful with those types of things that, okay, someone loads the money on there, and if you don't use it by a certain time, suddenly it's gone. It's back to zero. They may not be accepted everywhere. It depends on the system a merchant is using, but they may not be accepted. And then some store cards can only be used at that store. They can't be used elsewhere. So there's pros and cons, but again, we want people to at least be able to understand them and ask the proper questions to make sure if that's really the most useful tool for managing your money.
Let me just interrupt and say with a prepaid card, I would always check first at your financial institution, because with the places where you have your accounts, they may be able to offer you a better product. Because you have an established relationship with them. They may have lower fees. They may have a card that don't pay to load it, or one without an expiration date. So I would check there first as the first point of looking at these cards.
The credit reporting, credit reports and credit bureaus. Holly mentioned that the lenders are the ones who use your credit reports to actually give you credit or not. It's not the credit reporting bureaus. But a credit report, when we talked about that earlier, it's actually sort of, it's a record of how well you borrow money and how well you pay it back. So your credit reports are really interesting to look at, and we want to encourage you to do that because they show a track record. It's kind of like a report card for how you've borrowed money and paid it back. So we alluded to this earlier. There are 3 main credit reporting bureaus. They are Equifax, TransUnion, and Experian. We're going to get to that in a minute as well. But we want everyone, and that's you, that's your customers, everyone, to understand you need to check your credit reports at least once a year. And I say at least because there's a caveat to that. There is a website, and it's on your screen, annualcreditreport.com. This is the one website built by the federal government that allows you access to your credit reports for free. There's a couple other ones out there that, Credit Karma is running lots of ads right now. I can't speak to them. I've heard some people say good things, and other people are still leery because it's not the one that the government has said everybody's allowed to have their report. Go to annualcreditreport.com. So you'll see up on the screen there's the website address, there's an address, and if you go to their website you can print out a form if you want to do that to send it in, or of course you can apply online to get your credit report, or you can call them as well. And we want to make a note there that people who are blind or have low vision may request credit reports in either Braille or a large print or even audio format. So that's a good thing for maybe some of your customers to know. But when you request your credit report, do want to note that your credit scores are not included with that report. You will probably pay an additional fee for those if you ask for your credit score, although a lot of financial institutions now, whether it be a credit card or your bank or credit union, are giving you your credit scores now as a courtesy. So that's something that we're seeing a little bit more of. But your credit score is not automatically included with your credit report. Again, here's the three main bureaus, Equifax, Experian, and TransUnion. We've got their phone numbers, their websites directly, and their addresses. But when you're going for your free credit reports, you want to go through annualcreditreport.com. When you go to annualcreditreport.com, it'll actually ask you if you've gotten your reports lately, and if you haven't, what we recommend is you get the one from Equifax and Experian and TransUnion. So you're getting all three at the same time. If you have seen them lately and you know you're in relatively good shape, we start recommending staggering them, and every 4 months you get another one. So every January order Equifax, every May order Experian, and every September order TransUnion. So you're staggering them. And while Holly did point out earlier that every credit report is not the same, it'll still help you keep a running tally of what's happening, and you'll see suspicious activity. Most of the major creditors out there report to all three bureaus, but occasionally there's somebody who only reports to one and they expect it to be. So that's why they don't look the same, and that's why you still want to keep on top of each one. Credit scores, this score is based on the information found in your credit report, and it's kind of an indicator of, again, are you going to borrow money and pay it back on time? The main one that we hear about all the time is your FICO score, and that is the Fair Isaac Company. Scores range from 300, which is poor, to up to 850, which is the holy grail. The higher the score, the better. A lender will look at that score and say, wow, you're a really good risk. You have a great credit score. Therefore, that means you borrow money and you pay it back. So therefore, we're willing to lend you money for a house, a car, another credit card, whatever it might be. It is possible for someone not to have a credit score. They may not have a credit history at all, especially if they're just coming into adulthood and they've never been on an account or anything like that. So it's possible to not have a credit score or anything on your credit report for that matter. Now, this kind of goes back to the question we got earlier in talking about the components of your credit score and how that can affect whether you want to make a decision to get rid of a card you have or things like that. Your payment history is 35% of your score. So obviously that's the bulk of it. Or if you are making payments on time, that history is the most crucial part. It keeps 35% of your score up. The other biggest part is the total amount owed. They're going to look at your credit report and see how much debt you have if you have 3 different credit cards and one of them's maxed out but the other 2 are almost at zero. There's ratios they look at with credit or debt to income ratios. So you want to make sure the amount that you owe is actually manageable and keep that down because that's 30% of your score is how much debt you have incurred. Also saying that installment credit, mortgage or a car payment or student loans is viewed much more favorably than credit card debt. So revolving credit is viewed a little, again, there's this algorithm somewhere behind the curtain that we don't know exactly what it is, but that's how they calculate the scores. But at any rate, so there's all kinds of different weighted measurements. The next thing is your length of credit history. If you have a card and you've had it for 25 years, but they're still charging you that fee, That's 15% of your score for having that 25-year history with that company. However, if you have another card that's 20 years old, get rid of the 25. You probably have enough credit history, assuming it's good credit history, that you can get rid of the card with the fee. But again, there's some, you have to sort of ask what the rest of your credit report looks like. New credit is 10% of your credit score. And when we say that, we've got people out there who will, I got a credit card offer, that introductory offer, it's for 6 months, but it's 0%. And so they transfer all their credit card debt to that for 6 months. Then they open up 6 months later another credit card and transfer all their debt. Well, they're leaving in their wake a bunch of opened accounts, and you start getting, again, it's that, I've got this much of a credit line, but I've got this much debt, and the debt to credit ratio starts getting out of whack. So the bottom line, as Holly said before, is use what you need when it comes to credit. Christmas time at the mall or the holiday season, every merchant, you can save 10% today by opening a store credit card. Well, if you're spending $500, that might be worth it. If you're spending $5, certainly not. So really stop and consider, the purchase you're making. I opened a card at Home Depot when I was buying a new lawnmower because it was a fairly pricey purchase, and I thought I can save, it was $75 I think it saved me because I opened the credit card. Well worth it. Never used it since, but it was worth it to open that. Now I actually need to close that account since I'm not using it, but that's okay. The last thing, I already touched on this, is the type of credit in use. If it's installment credit versus revolving, that's 10% of your score. So every one of these pieces of the pie is weighted as far as how it affects your score.
Yeah, if I could just add something about the new credit. You hear a lot of times about people saying, well, I can't apply for new credit because it's going to drop my score. And the reality is, it's 10% of your score, so that might be true. But also it's really important to shop around for major purchases. For example, if you are applying for a mortgage, you're to that point, and you're worried about, I can only go to one place because if I shop around for mortgages, my score is going to drop. Well, there are exceptions for these major purchases. If you are shopping for a mortgage, any inquiry that you've made to mortgage companies within a 30-day period of time doesn't even affect your score. It doesn't even show up for scoring. Now, if you say, I'm not ready to buy a house now, 6 months later, it's past that 30-day sort of window, all of those inquiries that you've made 6 months ago now actually account for one inquiry for scoring purposes. So it really doesn't hurt you to shop around for mortgages and for auto loans. Those are the two key protectors you have to shop around for those rates. So feel confident that if you're buying a house, shop around, get the best terms. If you're buying a car, shop around, get the best terms, because it's not going to hurt you immediately. It's not going to affect your score, and if later on it accounts for one inquiry for scoring purposes. So it's, again, really important that you'll be able to not worry about your score when shopping for those products.
So why is your FICO score important? Obviously, it helps determine if you qualify for credit, and the higher your credit score, the better interest rates you're going to get. So again, it helps you, helps a lender determine how much they're going to give you and at what interest rate. So it's good to have a nice high FICO score.
Now let's see what that really means in dollars and cents. Okay, here is a chart for a 4-year, 48-month used car loan for $10,000. If your FICO score is in the top range, and these are real numbers from March of last year from myfico.com, not an advertisement, just saying the source. So if your high score, 800 credit score, your interest rate, basically for simple, what am I trying to say? To be simple about it, 3.34% or 3.36%. So your monthly payments on that $10,000 loan would be $223. The total amount of interest you pay over that 4 years is $702. Now, if you have some credit issues and your credit score is, let's say, 620, because that seems to be a magic number these days, 620, your interest rate would be over 9%. Over 9%. That brings your monthly payment up, if I can see that across there, $250. Your total cost of that credit over that 4 years is over $2,000. So you can see the difference right away. Now, if you really have some compromised credit issues and your score is, let's say, 550, your interest rate is over 14%. $275 is your monthly payment. The total cost of that loan is almost $3,200. So poor credit costs. So this is why we want to encourage our customers, along with ourselves, to have a good credit history, because it's going to hit our pocketbook if we don't. So how do we do that? Of course, make your payments on time and lower your debt. Those are the 65% of your score is based on those two factors. So those are the credit practices we need to employ. One thing I want to take a side note and say, we shouldn't be chasing a score. We know that a score isn't important in terms of money, but it's more important to do those good credit practices. Then the score will follow. So don't think of your credit necessarily in terms of the number, although we're all about the numbers and what's your number. But use those good credit practices. The score will follow. That being said, if you have some issues and you're trying to improve your credit, know that if you get back on track with making those payments on time, it's not going to take a whole lot of time for you to see improvement in your score. The creditors usually report for scoring purposes and for reporting purposes every 30 days. So, every 30 days, if you make that payment on time, that is going to go towards, a positive credit history. So it may take 6 months, depending on what your situation is, but it's not going to take, 10 years to improve your credit if you start employing those good credit practices right away. So it can change quickly. That being said, if you have some missteps in your credit, it will affect you basically immediately right away. So just so you know. So pay off your debt, make those payments on time. That's how to improve your credit. Last but not least on this topic, what if you do get your credit report and you find some errors or some mistakes, some accounts that aren't yours or some accounts that you've paid off or what have you? It's really important, 3 things. Check, correct, and follow up. How's that? There's activity 15 in the book, which asks you some questions. Did you get a copy of your report? Was all the information correct? Did you follow up and make changes if there weren't any, if there were corrections? And did you get a follow-up report? So again, really important, check, correct, and follow up, because that's your score. The information is affecting your score, and we know your score is going to affect how much you pay for credit. So it's important to do that. And it doesn't cost you anything.
And actually, the statistics say that 1 in every 4 credit reports has some type of error. It may be something just that somebody misreported or missed a payment, or something wasn't properly recorded. But it can also be, again, a sign of identity theft. So 1 in 4, I'll get there. 25% of credit reports have errors. So you do want to follow up and correct those errors, because they can affect your score. Is your credit report and score yours and yours alone? Or does it have to do with significant others, authorized users, etc.? If the answer is basically yes, your credit score is yours and yours alone. I do remember my husband and I going for a mortgage, and they said, "Ha, your husband's score is better than you." It was by 3 points, so I really didn't care. But people do get competitive over things like this. But yes, the score is yours and yours alone. However, if you allow authorized users onto your account and your kid goes off to college and runs up a bill you know nothing about, obviously that will affect you, because being an authorized user on the account, that's going to affect your account, which is still yours and on your credit report and score. Did I say that right?
Yes. Also, if you co-sign a loan, really important, you now become responsible for that debt. So, and also if you have joint accounts, a joint credit card account, that information is going to be on your report as well as the person you're joint with. So you really have to think twice about co-signing loans. Know that you become responsible. That's going to affect, the amount of credit that you have, the amount of debt that you have in your ratios. It's also going to, any mispayment made by that person who's taking out the loan that you're co-signing, that's going to come on your report. So you have to be, cautious about any joint accounts or co-signing accounts.
Absolutely. And actually, Holly and I are both working with another population over at Corrections. And one of the things that's come up, and which may come up with your customers as well, is power of attorney. And that some of your customers may be giving somebody else access to all of that information. The only thing we can say is you really need to trust that person who's got power of attorney, because they can wipe you out. We've seen it. Family members, well, so and so's incarcerated, so we're gonna take all the money out because he gave me power of attorney. You want to be very cautious with things like that, and making sure if your customers are talking about getting a power of attorney, that they truly understand what they're doing and they've got truly a trusted person that they're working with. So as far as that goes.